Okay, now that we've learned that you can measure risk by things like standard deviation, like particularly for mutual funds, and beta for individual stocks, let's look at a couple examples in mutual funds and stock mutual funds and stocks, individual stocks, and how you can find this information really quickly without having to dig real deep or do a lot of calculations. So let's look at a couple as far as a case study and kind of compare several against each other. And you don't have to calculate this. You can find it very, very easily. A lot of different sites do it, Yahoo Finance, a lot of different places you can find it. I found really easy and real fast is just to go to google.com /finance or Google Finance, and you'll find it very, very quickly. Because all you have to do is, once you get to Google Finance here, you just go into the search finance, you put in the name of the company or the mutual fund and the ticker symbol, and boom, there it is. You can find it easily. So I'm going to show you right now how that kind of works, and we'll look at a couple different funds and individual stocks so you can get kind of a comparison between what we were looking at with standard deviation and beta. So let's start with standard deviation. You can use that for stocks too, but a lot of times that's used really for mutual funds. It's a very common measure for mutual funds. So let's use it in terms of mutual funds. So let's look at it. I'm going to look at a fund called Oakmark Select. I start typing in Oak and I can find it, or I happen to know the ticker symbol here, but this is Oakmark Select. Oakmark Select is a very concentrated fund. It's invests in large cap stocks and mid cap stocks, but only holds 20 stocks in its entire mutual fund typically. So it's not like a big S&P 500 fund with 500 or some fund with more than 500 individual stocks. It's got 20, so it should be more volatile because it's got less stocks around it. And it is certainly a more volatile type stock. So we want to use this as a first comparison. You can see it's a large blend. It's got mid value and growth type stocks here off to the right, and it's also got some mid cap in there, but tends to more to the large right now in this particular snapshot. So if we looked at down here where first they'll come up with Oakmark Select, you can see the price. If you just scroll right down real easy, right underneath where it says risk, whoa, what a concept. You'd find it there. They actually list the beta and some other risk measures here as well. But we're looking for standard deviation for our purposes, and here it is right here, standard deviation. And they give it to you over 1, 3, 5 years, 10 years. So you can, it's really nice so you can see if there's any changes around risk that might be happening over time. Sometimes with an actively managed fund, you might have a new fund manager come in, somebody's managing, they're making choices that might be either more risky or less risky than the previous fund manager. And so that might have an impact there, or just as far as their philosophies change. So if you can see over the past year in this particular snapshot, 18.82, pretty high. That's a very high standard deviation, at least over a year. Now, that's only a short period, but that's a very high standard deviation. Even these are high, 13.76, 14.0 over 3 years and 5 years. And certainly over its life, it runs a high standard, over the last 10 years has a high standard deviation. And that's what we would expect, a fund that's investing in a real concentrated amount of stocks. You have less stocks to kind of offset that volatility, and the way they invest, looking to get a great return, they're going to be taking on more risky type stocks. And they talk about that in the prospectus, and they give you warnings and things like, if you're investing in this fund, we're hoping for great returns, but this is not the fund for you if you're looking for a real safe dividend payer. Let's look at this fund. So we got, let's say 18.82 and 13.76 over the last year and 3 years in the 14. Let's compare it to something that is a dividend type paying fund, something that has more stocks, has a whole bunch of stocks in it, and is really made for dividend paying out dividends. And we're going to look at the T. Rowe Price Dividend Growth Fund as far as our comparison purposes. Once again, I'm not recommending any of these funds. I'm using it to just show examples, so these are just examples as far as different funds that we have. I may or may not own these funds actually. I did own T. Rowe Price Dividend, or I actually have a small holding in that. I don't own Oakmark, or the next one we're going to look at here. So just to give you a feel for that. But this is strictly for education. Anything could change any moment, so we're looking at education. All right, so the Oakmark fund, real concentrated, less stocks, pretty high volatility, looking at that 13 to 18 type range over the 1 and over the 3 in the 1 year period. Here with the T. Rowe Price, dividend payer, standard deviation 11.2 over 1 year and 10.2 over 3 years. You can see over 10 years a little bit higher, but over the last 3 to 5 years around 10. Much lower. So less deviation, less changes, less volatility, and you expect that from a large cap, kind of growth oriented, though a dividend payer actually. So you'd think it would fall more in the value category, but still a lot more safety in there, a lot less risk as far as large caps, big companies that pay regular dividends out there. And if you were to search a little further, you can just even look at the top 10 holdings, give you a feel. Big drug company like Pfizer, General Electric, Danaher Corporation, Microsoft, United Health, Pepsi. These are big companies that pay regular dividends out there and have for some time. So they should be less volatile than let's say, that Oakmark Select Fund. And maybe this fund might be more volatile than something even safer than that. But this is a less risky, less volatile fund. Let's look at one more to give you one last example. And we're going to look at a technology fund, a sector fund that is concentrated in the technology field. So before we pull this up, think to yourself, technology, is that going to be, and it's a sector fund, so it's really investing strictly into technology stocks, is that going to be more volatile, more risky than maybe this dividend growth fund we looked at with T. Rowe Price? Well, if you answered yes, you're right on. I mean, that's the nature of technology. You're looking for growth, you're taking on more risk with the hope of a bigger payout. And a mutual fund might help, make it a little bit more easier than, let's say, an individual stock, but still, it's a technology concentrated fund, so it should be even more risky. So we're going under Google Finance, under risk, standard deviation, and boy, this is even more risky than the Oakmark fund, right, which invests in a lot of different types of stocks. It's not limited. This is strictly technology, so now we're at 19.58, 14.96. You can see 16, last 10 years, 22, lots of wide swings in growth, technology type companies. So when you're looking at standard deviation, here's a nice easy way to find it amongst other types of values. You can see this technology fund, look where they're investing in: Apple, Facebook, Alphabet, which is Google, different things, Microsoft, Yahoo, real high technology companies. So you're going to have more of that volatility. So here's a way to get a feel for what your risk profile is and whether you like risky stuff or not risky stuff. You can look at like the standard deviation if you're looking at a mutual fund in particular and see, some are less volatile than others. You don't want that to be your only decision-making thing, but it's a real key thing when you're making choices. Because if you get something that's really volatile, you might sell it right away at a loss, and you don't want to do that. You might want to have something that fits you a little bit better. Now let's take a moment and look at beta, and we're going to look at that for individual stocks. So we're looking at mutual funds and standard deviation. We can do the same thing on Google Finance and find beta real quickly for individual stocks, and it's really super easy. So let's start with a real safe, well, I don't want to say safe, that's not a good word. Let's look a real less volatile type stock. Its prices don't change all that much. It's a real steady Eddie dividend payer, and falls in that category of utilities, which utilities are known for being companies that are usually government managed a little bit more, and they pay out regular dividends. Utilities were always the home of grandma or the widow who owned some stock because they pay out that income, pay out those dividends. And we're going to look at a company to get us started here called Xcel Energy. It's a United States-based company. It happens to be, and Xcel does utilities like electric utility, those types of things. And as far as finding its beta, you don't find it here under risk like you do with the mutual funds, though they do have some nice good stats and things on the bottom right here and some information. But to find just the beta, it's real simple. It's right at the top here. You can kind of see it right at the top here where it says beta 0.11. All right, and so as you remember from our lesson on beta, beta is equal to the market of 1.0 is the market, is like the index. So if this stock happens to belong in the S&P 500, which it does, large United States stock, it's the index is at 1.0. If you're greater than 1.0, that means it's more volatile. An individual stock would be more volatile than its index. So an index has volatility to it because it's still a stock index. And if it's greater than 1.0 and it's beta, that means it's even more volatile than the index. So that's a lot more risky, a lot more price changes, a lot more volatile. And if it's less than 1.0, it's less volatile. And as you can see with Xcel Energy here at a beta of 0.11, it's a very low number, very much less volatile. So if you wanted something that was low volatility, maybe pays out a good dividend, which this does, a 3.26 dividend yield. So owning the stock, you're going to get 3.2% back on your money just by holding the stock. Once again, assuming they don't cut the dividend or anything, as we learned, so just be aware of that. But if you want a real safe, less volatile, type of dividend paying stock, Xcel is at 0.11. I'm not recommending it. I'm not recommending utilities. Everybody's different. I'm just saying if you look at it from a beta, if you were to ask me, is this a low beta stock? I'd say it's an extremely low beta stock at 0.11. Well, let's move up the chain a little bit and let's look at another type of stock. to see if that's a little bit more volatile. Let's look at, let's say Coca-Cola. I happen to know Coca-Cola is KO. Otherwise, I can, in Google Finance, I can just start typing it in and it will find it for me. KO is its short ticker symbol, KO. Coke, by the way, this is the bottling company, different company. So if you're looking at Coke, regular old Coke, international, big international company, Coca-Cola sells Coke and Diet Coke and a lot of other beverage products. You can find it here, and you can see our beta right here, right at the top, real easy to find, 0.57. So it had a similar dividend yield, by the way, to the utility company, but it's going to be more volatile because it's got a bigger number in its beta than the utility company of Xcel at 0.11. Still less than 1.0, still a lot less than its index, once again the S&P 500. So this stock is a very less volatile stock, and that makes sense, right? It's a 100-year-old company, been paying out dividends forever, big international company, solid company. From a balance sheet standpoint on it, it's going to be less volatile. It's not a high-tech, high-growth company. You know, it's a growing company, but it's going to be a lot less volatile than, you know, some other companies, and much less volatile than the index at 0.57. Remember, if the index is at 1.0, less than 1.0 is less volatile, over 1.0 is more volatile. Let's look at two others real quickly and see some more volatility as we move up the kind of the list here. Let's look at Amazon, right? Amazon.com. If you were to guess, you'd probably guess that is going to be more volatile, probably more volatile than Coke, and probably more volatile than the index, right? As a large company stock, again, we're looking at large company stocks for fair comparison, and it is. It's 1.11, so it is above that 1.0, and this would be a more volatile stock. And we would know that, right? Just from watching the news, we know Amazon's pricing and all that goes up and down. The stock price goes up and down, you know, more wider swings as far as for Amazon. As far as its volatility that occurs over a period of time. We could even look here at the 52-week range of pricing, where you can see over the last 52 weeks of this particular thing was $474 to $790, so a pretty wide range. But we're looking at volatility as a good measure for that, and 1.11, that tells us, okay, I'm going to be taking a risky stock, but maybe I like that for a lot of other reasons why I want to invest in, let's say, a company like Amazon. Just understand it's going to be more volatile. The last one we're going to look at, let's look at a real volatile, like crazy volatile stock. I mean, you think Amazon's volatile. I mean, most people like buying individual stocks in Amazon got to have that iron stomach because it's going up and down, up and down. And we're going to look at SanDisk here. And SanDisk, you know, they make the you know, cards and things for like your photo, for your devices, you know, memory cards, all that kind of stuff. So it's SNDK. Or you can just start typing it in, or you can find it, SanDisk Corp. And SanDisk has been up and down. They've been having some hard times at this period of time we're looking at, but some, you know, potentially good times too. So they're very volatile right now, real speculative in a lot of ways. And you can see that in its beta of 1.92. So think about how crazy volatile Amazon is at 1.11. Now something that's you know, a lot more volatile than Amazon, not twice as volatile, but getting there. You're at 1.92. That is a very, very volatile stock. And understand that your risk and your reward could be great, but it could also be, you know, on the other side too as well, as far as in terms of volatility. High-tech stock with a lot of volatility or risk in it. So understanding if I'm investing in SanDisk, I might experience more fluctuations in price than I would with Amazon. And if I want something a little bit more safer that pays me a nice dividend, well, then I'm thinking Coke. And if I want something more, even super less volatile, then it might be a utility company. And that was the example of Xcel. Okay, so we've looked at some companies. Really, the thing I want you to take away from this is where to find standard deviation, where to find beta, so you don't have to calculate it. You can just get it real quickly and find that information out and understand how it fits in your overall portfolio, that things that are more volatile are in a sense more risky and can cause you a little bit more sleepless nights. So with that, that concludes this lesson.